Despite the stock market being significantly larger than the balance sheet of the Fed, it's clearly apparent that every move that they make has a direct and profound impact on what happens. Fed meetings have every investor on the edge of their seat, awaiting the next rate cut to soothe their anxiety. They need that drip to save them for another day. This cannot persist forever, of course, but nobody cares about tomorrow, only today. The economy has been heading downward for a year or two, depending on which statistics you pull up. But none of that matters as long as the Fed is there to take care of us all. You came here for the truth, so let me unveil that for you. Today we are going to look at some interesting statistics. I want to talk about the Federal Reserve. I want to talk about what's happening in the stock market. I want to look at some of the numbers behind that, and I want to show you some economic stats that I haven't given you an update on in a little while. So let's begin right away. Fed repo injections and bill purchases. You could see the outstanding repos, that's the red, and the T-bills, that's the blue. Clearly, we've gone into a territory they weren't expecting to get to at such a rapid rate. It's over $400 billion in a short period of time. And I was thinking to myself, prior to the financial crisis, if we heard the number 400 billion, it would really make us shocked. We would be cautious about what it is, and we would be really listening. Today, we hear that number of 400 billion, and we glance over it. We simply ignore that information because it's not in the trillions, it's not in the quadrillions, can't be that important. It has truly gone into bizarro world territory, and that is unfortunate because that just means that the inevitable crisis will be far, far worse. This is the term repo operations. You could see what has happened over this period. Some would argue that this has eased a bit, but the problem is still going on and it's not going to get any better, particularly as the Federal Reserve tries to pull out support. It's going to be a wild ride. There's no doubt about it. This is a chart I've shown many times before. Weekly change in the S&P 500 and the weekly change in the Fed balance sheet. You can see the complete correlation right here. There is no denying this whatsoever. If the Federal Reserve stops with their interventions, you know it's like pulling the plug out. There won't be any energy left. Imagine it's like a laptop or a cell phone and it's plugged into the charge. And everything's running fine. Everything's running fine as long as it's plugged into the charge. But as soon as you unplug it, now you're on battery power. And that only goes for so long. If you look at what the Federal Reserve did for a period of time, they were running on battery power. QE3 ran out, and then you could see that it took a little while. As soon as they started that quantitative tightening, essentially the battery was draining. They had to plug back into charge, and that gave them the juice that they needed to get this going again. 2018 was that battery power period, and if you look at it today, there's some big differences between what we saw throughout 2019 and 2018. It's very clear to me. This is just an example of what they are doing on a daily basis. $56 billion injected. Nobody even cares. All of this information is overlooked. I'm going to show you some comparisons here, a couple charts for you. S&P 500 over the earnings. We're at levels we have not seen since the dot-com boom and bust. That connects in with this one. Price to sales is at a record high right now. There are so many indicators that have gone way beyond what we saw during the financial crisis. And in fact, going back to these levels of the year 2000 is absurd because everybody points to this time at their extremes, at the ridiculousness that we saw throughout this period. They laughed at it saying, oh, that was obvious. We knew that all of these problems were happening then. But of course, they only knew that in the rearview mirror, not actually at that time. But today, oh no, today is different because of this, because of that, and they have every excuse in the book to give you, none of which are actually based on reality. This is something that I've shown many times before, but haven't given you an update on the 10-year, 3-month yield curve inversion, obviously being so important. We have the yield curve inversion. This is the zero line, by the way, right here in both of these cases. And then, of course, you see what happens after that. Every single time we have a recession that follows. We are in that steepening phase. It's heading upward. Historically, this could be a period of time afterward. As far as I'm concerned, there's no real time in which we should be paying attention, but just know that this signal is definitely sending off a major red flag right here. This chart here shows you the eurozone manufacturing PMI, services PMI, composite PMI, all of which are looking really weak right now. Just more data to pile up. As we have watched what's going on globally, there has been some major changes that have occurred in the last, let's say, few months of 2019 as QE4 came into effect, as the ECB started pumping up their balance sheets. All of those resistance levels seem to be broken, and now we are headed into new territory for the markets that are largely ignoring this set of data that they were concerned about previously. IHS market Eurozone manufacturing PMI, just giving you an idea, going all the way back to 98, looking rather weak right now, going back into that level that we haven't seen since the Euro sovereign debt crisis. That's not a good thing because, of course, we could have a domino effect. This could spread very easily within the Eurozone, within Europe, and of course, onward and outward. The Baltic Dry Index is largely regarded as one of the most important indicators to be paying attention to. Baltic Index marks the worst day in 6 years on waning demand. The Baltic Exchange's main sea freight index on Thursday posted its biggest one-day percentage decline in 6 years, pressured by depressing demand for dry bulk vessel segments. It fell 114 points to 976 points, down below that 1,000 mark. I had just shown you an update on this in a recent video, and here we go, it's getting worse. The overall index declined by about 10.5%, biggest percentage drop since 2014. Look at all these different indicators, whether we're looking at the Baltic Dry Index, Capesize, Panamax, Supermax, and so on, all of them looking terribly weak, and yet the stock markets are roaring higher. They've never hit these levels before, ever in history. The optimism is at the most extreme I have ever seen, surpassing the year 2000. And yet the real stuff keeps piling up, not looking good. This is just comparing the Baltic Dry Index to the global manufacturing PMI. The red line is the global manufacturing PMI. This had started to come up in the last few months of 2019, and now it has dipped down again. So I'm going to follow this one. I'll bring it to you. As I've said in previous videos, the PMIs I want to really keep an eye on because there have been some that have continued downward, like the ISM, and there have been others that have started to actually reverse course and come back up. So that trend is extremely important. It's still looking weak regardless, but the trend is what I'm paying attention to. Class 8 truck orders, percentage change from a year ago, not looking good. When you see this, it has certainly gotten a lot better than where it was a few months back, but still looking weak no matter how you look at the data. They're going to blame it on China and the US. They're battling. Things aren't looking good between them, but don't worry because a trade deal is going to be signed in January 2020 and everything's going to be great after that. This trade deal is just about China purchasing agriculture at what they're going to call best efforts basis, whatever the hell that means, but it doesn't really matter because the markets are going to love it. The markets are going to love it, and it doesn't matter if it's real or not. ISM Purchasing Managers Index, that is the blue line, continues to weaken. And on top of that, you have the orange line, which is the commercial and industrial loans. That is a good signal as well because it gives you some insight as to what is happening. And there's no doubt these two together paint an interesting picture. There's weakness all over the place. And quite frankly, the only thing that's looking really good right now, last year as well, has been the stock market. That's it. Used truck sales return to downward track. Just more stats wanted to pile up here. And before I finish the video, going to touch on a couple points. This is from Real Investment Advice. You may have seen the Fear and Greed Index. I'll show you that in a second. This is a different one. This is Real Investment Advice's own Market Greed or Fear Index, and it is near levels that would be a record high. The optimism is just off the charts. No doubt about it. They are really piggybacking off of the quantitative easing, not just from the Federal Reserve, of course, but from all central banks around the world going into an easing mode. And I definitely understand why investors have this mentality right now because the money is flowing. It's easy. It's cheap. Just put your money into basically anything and it's all going to go up higher. This is the Fear and Greed Index that you're probably used to. Right now, sitting at 97. 97. That is crazy. But don't worry because I'm sure they'll figure out a way to get this over 100. We haven't seen anything yet. Don't look now, but Goldman Sachs is saying that the economy is nearly recession-proof. That is just fantastic. Goldman Sachs, who rules the government, is telling you don't have to worry because the economy is nearly recession-proof. That's right, Goldman Sachs with their tentacles, every square inch of the government, the alumni of which are constantly in this rotating, revolving door that never ends, that stretches beyond one government and into the next. And there are people who still deny that this is going on. If you don't understand what the corporations are really about, you are falling way behind. Learn about the corporations and learn about what they are actually trying to achieve. That's all for this video. If you found that informative, hit that thumbs up button. This is 2020. You got to hit that thumbs up button not once, not twice, but thrice. Thank you very much for that. If you want to build a business, if you want to learn how to make money, if you are interested in passive income, I created a free e-course. It took me a while to do all of this, and I wanted to be of service to those people who have asked me time and time again, how do I make money on the side? I need to figure out a way to bring in some cash. I don't trust the stock market and so on. This is just one of those ways. You can check it out for free, 100% for free, theamazongps.com. If you want to know about the financial system, you really want to understand it, but you don't want all that jargon that you are used to seeing out there, these two books have everything you need. You read these two, you got it all down packed. Check them out. Link is in the description. If you want the audiobook, themoneygps.com. Hang on a second, hold on. This video did not get nearly enough views, though it contains so much info. Definitely click on it and I'll see you there.